Hey there, Matt Walsh, coming at you from Academy Home Buyers. I'm also an agent with eXp Realty in Virginia Beach. And today we're going to do a quick talk about owner financing, what it is, how it works, and why someone like you would consider buying or selling a home with owner financing. And we're going to do that by looking at this property here today, right over here. This is a property I am trying to buy on owner financing. I am going back and forth with negotiations. I'm waiting for my phone to ring any second because I want it. I want it bad. All right, this is my bread and butter property here in the Hampton Roads area. It is a legal duplex. Each side is a 2-bedroom, 1-bath. Each side will rent for between $900 and $1,100 a month. This house needs work. This is just a Zillow picture, or I'm not even Zillow. This is like a Google Maps picture. It looks a lot worse now. It needs work. So this house needs work. It was listed on the MLS. I think for like $140,000 and then like $120,000, and finally they lowered it to about $80,000, and it expired. If anybody knows about the real estate market today, and right now we are in the middle of 2022, I can sell a shoebox on the corner for top dollar. Okay, so if a property does not sell, it's because of price. That's it. It's priced too high. There are enough buyers to buy that. There's a lot of people like me pining for this, for this property at the right price. So when something doesn't fit the right price as an investor, we got to figure out ways to make it work, right? I didn't see this when it was on the MLS. I think it was listed a little bit before before we came down here, right? But if you want something, if you want a piece of property, and someone else wants to sell it, you really got to try to figure out a way to meet in the middle, right? And price is not the only thing that motivates people, all right? There are other ways that we can meet and make both parties happy. And one of those ways is through owner financing. So what is owner financing, real quick? So owner financing is very big in the commercial world. When you see big projects, big buildings and developments selling for $20, $30, $40, $50 million, very rarely is there a bank writing a check for $30 or $40 or $50 million. All or part of that deal is being sold on owner financing, meaning that the original owner, the seller of the property, the project, is holding the note, is therefore taking payments taking payments as opposed to a lump sum. So we can do that with residential properties. It happens all the time, but it's one of those things that people don't really understand. I'm going to sell my house for $200,000, and then, well, how about owner financing? And they look at you like you have three heads, because it's not something that's normal in the residential real estate world. Like, well, if I want my $200,000 now, well, I can give you $200,000 over time, and that's all it comes down to, is paying over time. So one of the things that people are always concerned about when selling with owner financing is they think that it's just like a handshake, and I'm giving you my house or my property on the promise that you're going to pay, and what if you don't pay? Well, it's no different than a bank lending you money. When a bank lends a person money to buy a home in the form of a mortgage, a note is drawn up stating that the buyer owes the bank X number of dollars, and then that gets attached to the deed and gets recorded with the deed in public records. So that two things. Number one, the new owner of the property cannot sell the property without first paying off the mortgage loan, right? And then B, if the borrower fails to pay, stops paying, the person that holds the mortgage note can then seize or foreclose the property in lieu of payment. Well, as a owner finance, it's the exact same thing. So if I'm going to sell a property on owner finance, an attorney usually will draw up a note, which is basically an agreement of all the terms that are agreed upon, the monthly payments, the interest rate, the term, balloon payments, whatever it is, whatever you agree to, right? And that gets recorded with the deed and gets filed in public records, so that you, if you are selling on owner financing, are just as protected as a bank or a mortgage banker. If the new buyer of your home fails to pay, well, then you can foreclose and take that property back. And if that buyer decides to resell the home somewhere else, they can't sell it until you get paid just like the bank would, right? So the protections are in place. This is not like some handshake deal where you're giving away your property and then someone could run away with it. No. When done right, done legally, and a proper closing and deed transfers and loans are paid off and liens are taken care of and it's a very proper and normal way to conduct real estate business. Okay, so regarding this property here, like I said, it expired on the multiple listing service. Okay, at $80,000. I think I kind of ran it that the ARV, the after repair value for this house, should be about $150,000. Okay, it needs a lot of work. I've seen some pictures inside. I haven't been into it, but I've seen some pictures inside. It needs a lot of work. I think there's actually a tenant still living in there, but they're going to leave soon. But that doesn't mean anything. Let me tell you, tenants live in places that should be condemned. Many times I said, oh, well, there's a tenant in place, it must be livable. And you get in and you're like, oh my goodness, we need to call building inspector to get you out of here. Okay, but I don't think it's that shape, but it needs a lot of work. Therefore, I cannot pay, $85,000. This person wants $85,000 for it. I just can't do it. I could probably still make money as a rental, okay, but I am not tying up $85,000 or the down payment I would need to get a loan on $85,000 and then the money that's necessary to fix the property up. There's just too many moving parts and just not enough positive potential and a lot of negative potential. But maybe we can meet with owner financing. So I came in and I offered like $45,000. $45,000 is a number that I can come in with, put the necessary repairs in, pay for the taxes and insurance while it's being worked on. There's always an issue, especially a house like this. It's old. I think it was built in like 1905 or 1910. There's always issues. There's town issues. There's code issues. There's always issues. So that would give me enough buffer to make sure that me and anybody maybe I'm borrowing money from or someone that's going to invest with me is not going to lose any money. The goal is not to lose money, right? So came back and they don't want that. But he still wants to get rid of the house. Apparently he wants to get rid of it really bad. So I said, how about owner financing? So here's where we're going. I said, I can meet you maybe at $70,000, right? $10,000 below what he wants, maybe $70,000. But you got to give me time to pay. You've got to give me some ability to pay over time. Why? Well, number one, as a buyer, what that does is I will put a down payment. I offered to put a $10,000 down payment, right? So this will be we'll type as we go through it. Down pay. So I'm going to put down a $10,000 down payment, right? And then I'll pay the remainder over time, and that leaves me the money I need to do the repairs, right? If I were to get a regular loan, and to go to a bank or a hard money lender for a $70,000 loan, I would have to come up with 25% of that, and now I have a loan at probably a higher rate because banks don't like to lend little amounts of money. If they lend little amounts of money like that, under $200,000, they charge you more. Okay, and then I got to come up with the money to do the repairs. Whereas here, if I'll treat you as the bank, treat this, the seller as the bank. Give them a down payment so that they have some money to walk away with, and maybe they need it for whatever they're going to do next, and then I'll pay the rest later, and that leaves me money to fix up the house. And then when it's fixed up, I can go to a bank and get a commercial loan or a cash, a loan on the new after repair value, and I can pay them off completely, right? So here's the terms that I had proposed. Okay. I go to my Brett Whistle. I'll put the link down below. Brett Whistle amortization calculator. It's a completely free web tool, and I love it. I'm sure there's other ones out there, but this is the one I use for everything. I do about 10 calculations a day in there. So I proposed that we would do a $70,000 payment, all right, with a $10,000 down payment, which means that the loan would be for $60,000. All right, there we go. 60. My eyes are going. $60,000, right? Is that 600,000 or 60,000? 60. 1, 2, 3. I should put my glasses on, but then they reflect on the screen. Okay, so our principal will be there we go. Will be $60,000. All right. Total purchase, therefore, is $70,000. Okay, so what we did now, another great thing with owner financing, right, is that you can make up your own terms. When you get a mortgage at a bank, they have to fit certain things, and then especially with all the Dodd-Frank, you have to have A and B and C and D. With this is an agreement between two people. We can do whatever we want. So what I typically do is I go to about the prevailing interest rate. Right now we're talking about 4, so I'll give you a 4% interest rate. Maybe a little bit more than a regular bank, but I'm not going to pay all the closing costs and the buy downs and all that. And we're going to amortize it for 30 years. So what does that mean? It's going to have a payment schedule as though we're going to last 30 years. That gives you a lower monthly payment. Now, we could pay this off in 1 year, 10 years, or 30 years. Doesn't really matter, okay? But I typically like to do 30 years. And on this one, we can show the amortization schedule and hit a button, and that's it. Poof. So if we do that, I'm going to pay $286.45 a month. So I offered him, I said, I will give you $10,000 down. You hold the loan. You hold an owner finance for $60,000, right? I will pay you monthly $286.45. So now this person's going to sell the property, have no responsibility to it whatsoever. Not worried about taxes, not worried about insurance, not worried about anything. Although they will be listed on my insurance policy as additionally insured, so if something were to happen to the property, they would get paid off, just like a mortgage bank, right? But they're not responsible for anything. So this would be $286 in their pocket every month, okay? So we're going to take a look over here on our calculator. Okay, so what that would be is $200 in interest, $86 in principal every month. So they're making money on this every month. And I typically do 5-year terms, right? So we wrote the loan so that it would span 30 years so that we get our payment. But I typically say, all right, I'm going to pay you off in 5 years. So we're going to go down here to 5 years, right? So year 5. At year 5, over here, the 60 payments. There's the 60 payments, 5 years, right? I will still owe $54,268. $54,268, right? That's how much I still owe. Now, principal pay down, right? Over those 5 years, I have paid down the principal. So we go over here to this column, cumulative principal. Okay, I have paid down $5,731 worth of principal. $5,731 worth of principal has been paid, right? In those 5 years, I've paid interest on every payment, right? Which is money on top of the principal. So we'll take the interest payments and we'll go down here, and we've paid $11,455. $11,455 in interest. This is no different than if I paid the bank. But instead of paying the bank interest money, I will pay the former owner or the seller of the property, right? So as a seller selling on owner financing, right? You will have received $54,268, which I'm going to pay you on year 5, or we can agree to anything. I've already paid you $5,731 in principal, and I've paid $11,455 in interest, and I have also paid a $10,000 down payment, right? Which was $10,000. So look at this right here. By accepting seller financing of $70,000, you will have received $81,454. This right here is why seller financing really, really works for sellers, okay? And figure a bigger deal. Oh, we're screaming this. Figure a bigger deal. This is a house that's worth 60, maybe 60 or 70 grand. Figure a $200,000 or $300,000, $400,000 home, and you hold the note for $100,000, $200,000, $300,000. You could make a lot of extra money just on the interest. And it works for me, the buyer, because I would be paying the interest anyway to the bank or the mortgage banker, but instead I'm not paying an origination fee and a lender fee, and I'm not paying buy downs, all the things that mortgage brokers do. And then I can figure out whatever I want. A bank may say, "Oh, I'm not lending you money, without you putting, 40 grand down." Well, you and I, as individuals, we can agree, I'll pay you 10 grand, 5 grand, 20 grand, whatever works. So right now in this deal, we are in the discussion phase of this. Maybe he'll turn around and say, "All right, I'll accept, but I want more money down." Okay, right? Maybe he'll say, "All right, I want it paid off in 3 years instead of 5 years." Okay, we can work on, these are the things that we can work on as a private money deal that you can't do with a bank or a mortgage banker, right? Again, you look at the total, what happens is the seller receives more money. And in the interim, the seller receives money over time. This is great for tired landlords. Are you done renting? Are you done being a landlord and dealing with all the problems? Let me tell you, I have a couple of rentals and sometimes they're a headache and a half. But you can sell them on owner financing, and now you collect money every month and you're not responsible for anything. You've sold the property. You're not responsible for taxes, you're not responsible for insurance, you're not responsible for maintenance, you're not responsible for anything whatsoever. And you still collect money every month, just like the bank. Think about it. In a transaction, what do you have? You usually have a buyer, a seller, and a lender. Who is buyer, seller, lender? Who is least responsible for the property? The lender. Who makes the most money? The lender. Why shouldn't we all become the bank, right? It's the perfect thing. If you are thinking about seller financing, then I definitely recommend you speak to someone. I will be happy to sit down and talk with you about seller financing. And it's a great way to come to terms on a property that maybe you want to sell fast, but you need to make a little bit more money. Or if you want to buy and you don't have a whole lot of cash to put down, or for properties that need a lot of work and you want to save money to put the work in. There's a number of reasons why seller financing works great, and this is one of them. You can make an extra $11,000 simply by taking payments over a little bit of time. All right, I hope this helps. I will talk to you soon. If you have any questions about this or any other deals or things that we've talked about, shoot me a text, shoot me an email, go below, type it in the comments, and I'll get back to you. Have a great day.